Hey everybody, I'm Mark Reith here with Michael Finarelli and Sean O'Reilly, and welcome to the first Consumer Countdown of 2014. Welcome back, guys. Yeah, put on some holiday weight. Excellent. Today, we'll be taking a look at all the big news in the consumer goods sector, and we start with a look back earlier this week at Lululemon. Shares of Lululemon dropped on Monday on the news that it was cutting its fourth quarter earnings outlook due to slow January sales. Guys, a little interesting here that it's January sales causing the problem and not December sales. December, obviously, the most competitive month for most retailers. What's going on with Lululemon?
Yoga pants are great stocking stuffers.
Apparently,
so
yeah. Lululemon stockings. I like that. It's the next step. But yeah, well, what's going on with Lululemon that January sales are suddenly slower than the most competitive month of their year?
It's, a higher priced product. They sell these things for, $100, $150.
Right.
And people splurge, they buy them for Christmas and then
Makes
take
sense.
a break.
Yeah, absolutely. Probably a little cold out there for all those Lululemon
A little
fans.
bit.
So on the news, Lululemon went down, still down about 16% this week. Does that mean it's an opportunity for you guys? Or are you staying away from Lululemon until they announce earnings?
No, to be honest with you, Mark, I actually kind of like Lululemon here, to be honest with you. I know I'm going to ruffle some feathers, they've had their problems in the past, with Chip Wilson, of course, making all sorts of outrageous comments. They had the whole Luon fabric scandal and all that. Right. But when I take a look at Lululemon and I see the weakness in the current share price, I take a look and I still see a product with a very strong brand. Okay, it attracts to a higher niche. They've got a great in with different yoga studios and so forth and stuff. That's how they've built their customer base. And I still see a lot of strength there with this business. I think these could be temporary setbacks. So this could be a good opportunity going forward for investors.
What about you, Sean? Do you think they put Chip Wilson behind them?
I hope so.
Yeah.
The thing that came to mind when I saw this come out was the fact that they aren't the only retailer to say they're having a rough couple of months in this latest quarter, and they have a higher valuation than the other ones that have had issues. So that was my only concern there.
Right, definitely something to keep an eye on. Okay, moving right along, turning to some of our favorite distressed retailers. JCPenney was in the news this week after it announced it's closing 33 stores and cutting 2,000 jobs by May. Meanwhile, Sears announced that it's cutting 1,600 jobs, which is about 7% of its workforce. Guys, what is going on?
Aren't all retailers distressed right now?
Yeah. That's a fair point. Hey, let me ask you this. Is anyone more distressed than Sears and JCPenney right now?
No.
Yeah, hard to say.
So what's going on with them?
Have you guys actually seen the list of all the stores they're closing?
No.
JCPenney.
Tell me
I
more.
actually could not believe that there were even stores in these towns in the first place.
Oh, really?
There's one on the Upper Peninsula of Michigan. Great for camping, not great for opening up a JCPenney store.
Fair.
Couple in Warsaw, Indiana. I moved here, obviously, from Indiana to start this job. There's nothing in Warsaw. I'm sorry. I don't know. I'm kind of surprised these weren't closed years ago.
Right. Yeah, that's fair. They probably should have closed them years ago.
It's a fair point. I think, it represents, if I'm not mistaken, I think only like 3% of the actual store base here, these closures. So, it seems like they're cleaning house. And to your point, there's probably stores that should have been closed a while ago.
Right.
I'm anxious to see, because they mentioned that they'll get, by closing these 33 stores and laying off those workers, which obviously is unfortunate for them, but they'll save $65 million in costs this year. I'm anxious to see how much they'll not lose by operating them as well, because I can't imagine, these stores were, of course, hugely unprofitable. That's why they were closing. So they're talking about $65 million in cost savings. I'm wondering how much their earnings will go up, or however you want to look at that.
That's fair. That's
right.
Fair. In related news, now, earlier today, Sears announced it's partnering with Dick's Sporting Goods to lease some property at its King of Prussia Mall location to Dick's. Now, the discussion around Sears has long been the value behind its real estate. Is this the first sign that they're going to start cashing out on all that property?
I hope so, because you cannot bet on them as a retailer.
Right. Yeah. That's the next question. Is if you're investing in Sears, are you just investing in them for the real estate?
Kinda, yeah.
Is there any redeeming quality to their retail operations?
What's my answer to that is I don't think the company wants that to be the redeeming quality. Right. They are clearly not making an effort to become a retail. Like they're not. I went in there. I went to Macy's, Sears, and JCPenney multiple times during the Christmas season to get a feel for what was going on, all this stuff. And I mean, Sears was it was rough. Like, they aren't even trying to become a retailer or whatever. So they're clearly focusing on just maximizing the value, and this shouldn't be any surprise to anybody that's following the CEO, Eddie Lampert.
Right, absolutely. What about you, Mike? Do you think it's just Sears as almost as a REIT at this point?
I think so. I think that's, I mean, if you're looking at Sears, that's what you're looking at. I mean, if you can't drive sales in your own products, then certainly bring in other retailers who can possibly, hopefully get the job done for you.
True.
I mean, it's an interesting thought, but on the same token, for like a foolish long-term investor, you've got to look at the company, you've got to look at the competitive advantages, and I think you have to sort of stay within your niche as an investor and what you know really well. So, I mean, if you have insights into what the value of the real estate here is, or for instance, if there's value in the real estate that's not already expressed in the current share price of Sears, if there's ways they can monetize that would increase value for shareholders, then that's great. That could be a great thesis. But if that's not your stronghold as an investor, I think you kind of have to stick within your niche. For me, as a long-term, I'm looking at whether or not does Sears have an actual competitive advantage. And from a retail standpoint, absolutely not. I mean, they're facing tons of competition from every single angle. And even when you look at their strongholds, like their Kenmore appliances, Craftsman tools and stuff like that, I mean, you're competing now against the Home Depots and the Lowe's of the world who have tremendous scale advantage.
They have their own brands of tools.
Absolutely.
Too, yeah.
Absolutely.
The whole situation, like, I've been following Sears and Eddie Lampert and Kmart since, like, I was in college, and the whole situation is extremely interesting to me. But that was the thesis when the stock was at 120. Now it's in the 30s, and of course my interest is higher now because they actually stand to make some money. But you don't know how long it's going to take them to redevelop these properties, because you read that Baker Street report, and this equity analysis money management firm put out this 120, 130-page report valuing Sears like $120 a share and all this stuff based upon the value of the real estate. And they talked about like chopping up stores into basically smaller blocks and leasing it to, I don't know, Dick's Sporting Goods or whatever. But that could take 10, 15, I don't know how long that'll take.
Does Sears have that many years?
I don't know, because that's the crazy thing, because when it merged, they had billions in cash on the balance sheet. They were sitting pretty or whatever. Now they've just got $600 million in cash. They've got all this debt.
Not looking great.
Investing in it requires a ton of assumptions, and you don't have a ton to go on. You really don't.
Right.
That's
so,
well put.
Anyway.
What about JCPenney? You can't forget about them. What's the investment thesis there?
Hopefully a bounce back.
No.
Yeah. True, yeah. Hopefully they bounce back, they regain their customers. But I mean, even there, going back to, competitive advantage. What competitive advantage does JCPenney have over its competitors? Who goes to shop at JCPenney anymore? And I think you saw that in years past where they lost their customer base because they tried, they tried some different strategies. They tried to bring in a fresher, a new look. Better inventory, new look, try and bring in more customers, younger customers, and it didn't work out.
Yeah.
Even my own mother, actually, she just told me, she's been shopping at JCPenney for 30 years. She's like, this is the first Christmas I didn't buy anything at JCPenney. I was like,
there it is. Mama O'Reilly says
Mama
no more
O'Reilly,
JCPenney.
game over.
Absolutely.
There it is.
That's all the investment
Sell.
I need, yeah.
Press the sell button.
Well, no, the real question is just how much damage did Johnson do? Because the previous CEO that was, captain of the ship for a long time, and actually they did reasonably well under Ullman is back, and he actually just bought $1 million worth of their stock at, did he buy at 7 or 8 or something like that? It's at 6 now, but the real question is just how much damage did Johnson do? Can they get the customers back by just being the old JCPenney, or is it just it's too little too late?
And that's a great point, and that's also a great vote of confidence by Mike Ullman. I'm very sorry. But I mean, it goes to show, yes, of course, there might be some dead cat bounce here. If as JCPenney regains some of its customers, margins start to come back to approach historical levels. But going down the road as a long-term investor, what advantage does the company actually have beyond that? It's more of in my opinion, it's a possible speculative short-term play. But that's exactly what you're doing. You're speculating on a bounce.
Yeah. Fair enough. Definitely something to watch. All right, in other news, Time Warner Cable rejected Charter's third acquisition offer, this time for around $37 billion or $132.50 a share. Time Warner's board said that the offer was, and I quote, grossly inadequate, and instead said it would consider $160 a share to be more reasonable. Is that reasonable?
No.
Right, Time Warner's been struggling a little bit. They dropped CBS and lost 300,000 subscribers or something?
They're not even being remotely reasonable with any of this.
Right.
First and foremost, I actually think this is the 37th offer if you count all the backroom kind of, hey, do you want to merge talks or whatever? Anyway.
Fair point.
No, you look at the cable industry, and they're all at the top end of any trading range for the last 10, 20 years.
Yeah.
You're in a 5-year bull market, all this stuff. They're pretty much all trading at 18 to 20 times earnings. Shaw Communications, Comcast, every single one of them is trading for 18, 20 times earnings, including Time Warner Cable. They're currently trading for 18 times earnings, period, end of story. Their market cap's $130 billion. That's the other thing with all these companies. Like, how are you going to grow? Like,
right.
Like, let's just be honest.
Well, the name of the game is consolidation in cable these days.
Right, and that's why they're doing this.
Right, absolutely.
The funny thing, like the Time Warner Cable CEO, correct me if I'm wrong, I'm pretty sure he said, oh, we won't let them steal this company or whatever. You're asking 22 times earnings at 160.
Right.
Is that...
Doesn't seem fair.
It doesn't seem reasonable, you know?
Absolutely.
So...
Yeah, all right.
The other thing was, the offer at $130 was partially stock. I think it was like 45% stock. So they get to participate in any cost-cutting, upside there. So it's not like they're trying to steal anything. I don't know. Like, 160 seems a little unreasonable to me.
Unreasonable indeed. It's going to be interesting to watch, see where Time Warner goes. And by the way, that brings us to our main topic today. We're turning towards net neutrality. Now, for those of you who don't know, net neutrality refers to a ruling from the FCC that internet providers must treat all content the same way. That means a video on YouTube will stream at the same speed as a home video of Sean's cat on his blog. However, a federal appeals
How'd you
court
know about
ruled
that?
on Tuesday. I'm sorry about that. He doesn't have a cat. Doesn't have a blog. Do you have a cat?
I'm actually allergic.
Oh, well, then he doesn't have a cat. I guess.
Nope.
Now, on Tuesday, a federal appeals court ruled that the FCC can't actually enforce these rules, which opens the door for internet providers like Charter, Verizon, to basically charge us what they want for streaming internet. First and foremost, this kind of sucks for us.
This is not good, especially when we just got done talking about how they're all consolidating.
That's true.
I do want to admit, though, I do have a honey badger as a pet. So,
Okay. But yeah, I think this is going to get passed on to us, right? These costs are eventually going to hit us on our bottom line.
In some fashion. In some fashion, they have to. I mean, of course, the providers, the carriers, are trying to recoup the costs for all the infrastructure investment, of course, over the years.
Right.
So I mean, it's natural to come on us in some way, shape, or form, whether it's tiered pricing from your internet provider, or whether it comes from actually the likes of Netflix if they get charged higher fees, and that brings the decision to them. Are they just going to take a hit on profit then, or do they ultimately have to pass it along to consumers?
Right, and Netflix is down big time this week on this news because they look like they're going to be the most heavily impacted out of all the companies out there. They depend on fast streaming, high quality streaming video. As
or $8 a month.
Right, I mean, and that's a reasonable price. Are we going to see that price increase to the point that Netflix starts losing subscribers?
I don't. It's just because then you put Netflix in the position of being a price taker. I mean, like, that's. Do they be like, okay, like we got to charge people $12, $10, or $8 for $8 terrible streaming? Like, is that what happened? Because I can't imagine them basically taking action without figuring out what the cable providers are going to do.
Right.
But does that put them in the position of just being at the behest of these cable companies then?
And it absolutely puts them in a weaker position than like a Google, because Google, obviously with YouTube, also depends on high quality streaming video.
Right.
But Google's wallet is a bit bigger than
Little
Netflix's.
bit.
Just a little bit.
Sure.
Just a couple $1 billion more.
Sure.
So I think Google's not going to get hit as hard. That might be an opportunity for them to overtake Netflix in some areas, like streaming video, for instance. But what about the providers? What about Comcast? What about Charter? What about Verizon? Are they just going to start rolling in the dough after this ruling? You don't think so?
I don't think so.
It almost seems like a defensive move from their perspective, just because they are having a hard time basically getting people to, because these cable providers make money on one, internet, but two, cable television, people watching NBC, CBS, and then like HGTVs and all the more specialty channels and everything. And slowly but surely, people, especially in my generation, were starting to cut the cable and just use the internet and just watch Netflix. This is their way of combating that, so still a defensive move for them. But, like I said, all these companies are trading 18, 20, or Time Warner Cable wants 22 times earnings. You might as well, they're kind of like owning bonds. get a 3 or 4% yield and it grows a little bit. And that's it. Like,
Interesting. Okay, so does that make you want to invest in these?
no.
Not looking for that. What about you, Mike? Are you thinking about it?
No, you know what I am thinking about, and the question I actually have is going back to the actual content providers. So you know the question becomes, or really what this reveals is the fact that content even more so becomes king. You know,
Yep.
so if you have content, if you have high quality content, then seemingly at least you wouldn't necessarily be competing so much on price. So and I think to an extent, wouldn't this affect all pretty much, you know, streaming providers in the same way? Granted, I mean, Netflix is the larger of the share here in terms of how much actual,
sure, yeah.
you know, broadband capacity and things like that. But I mean, isn't the consortium of Hulu also going to be impacted by this, and Amazon as well?
Which couldn't find a buyer, by the way.
Yeah. Do you think Hulu's ever going to go public?
I don't know.
Tangent. No?
I don't know.
You don't think so? I would love to see
I
Hulu
kinda
go
doubt it.
public. I think that'd be great. I think that'd be a lot of fun.
Yeah.
All right, speaking of gossip, let's turn now to the latest gossip on Twitter. Today's tweet comes from friend of the Fool and CNBC host Carl Quintanilla, who wrote late yesterday, "No wonder Hershey is introducing chocolate spreads. Nutella U.S. sales have more than tripled in 5 years." By the way, when Carl said chocolate spreads, I actually thought he meant like options, like there's going to be a strike price. I was very confused, but also very happy for a moment.
Is that on the Chicago Mercantile
Exactly,
Exchange? What's going
exactly.
on?
Hershey's Nutella swap.
That's
You get one
not
of
what
those?
he meant. That's not what he meant. He meant actual spreads you can put on, say, your strawberries or your sandwiches, what have you. Hershey has announced 3 flavors so far. They've just got plain chocolate, chocolate with almonds, and chocolate with hazelnuts, which is a direct combat or a direct blow against Nutella. Can Hershey really horn in on this market?
Yeah, I think
I think they
absolutely.
Absolutely.
It's their next big growth market. No.
Think so? I mean, they're the biggest chocolate maker in America.
They
But
are.
Nutella, their sales, I think it was $240 million in the last 5 years. Crazy.
Nutella is a staple in the Finarelli household. Let me tell you that. It is. It is.
Great, you know what?
Peanut butter Nutella sandwich?
Right.
It's money.
Right. You can't. Oh my God. Just use your finger. Who needs
you-
a sandwich? Are you a Nutella household?
Of course.
Now, James Smucker had a product that they tried to take down Nutella with. I don't
Oh,
think
and it
any
didn't
of us
work?
have that. No.
Oh, I didn't know
Do you
that.
eat James Smucker's hazelnut
I didn't even
spread?
know.
I don't either. Exactly. So you're saying Nutella versus Hershey. Who are you buying for your son's lunch?
I propose
well-
a taste test.
It does deserve a taste test. I do have to say that. What I will say about as far as Hershey and the opportunity that they do have, they own 43% of the U.S. market, chocolate market.
Yep.
So I mean, tremendous brand. You want to talk about competitive advantages like we do always around here at the Motley Fool. Tremendous brand power. Certainly could enter this market and provide stiff competition to Nutella.
Absolutely.
I think it deserves a taste test.
Absolutely.
In other chocolate news, by the way, Hershey announced today that it's partnering with 3D Systems to begin developing 3D printed candies. Great idea or greatest idea? I can't wait for 3D printed candies. I think this is going to be so
Will
much
it
fun.
taste different?
That's a great question. Again, taste tests need to take place. It's for
Because theoretically, I
science.
thought about it, and I was like, well, instead of plastic in the mold, you're just putting chocolate.
No,
so-
it's a simple switcheroo.
Chocolate
Logical.
molds.
Chocolate
Logical.
But it
sense.
depends on the source of the chocolate. I mean, anyone can make a Hershey Kiss, right?
Okay. If you
Right?
say so.
Well, anyone can
Okay.
can make what looks like a Hershey Kiss. Only Hershey makes the Hershey Kiss.
There it is.
But it depends on the source of the chocolate, how good the chocolate is.
How do I get one of these machines in my home?
You spend a couple $1,000s and make a deal with Hershey to do that. Are you going to buy Hershey on the news that it's got 3D printed candies now?
It's another bond alternative in terms of stocks, so
Okay.
I don't think this can be another. But it trades at, I mean, I haven't checked recently, but 20 or 30 times earnings, I'm sure, and it grows at whatever U.S. population grows at.
Right. It's long-lived, it's stable, and you got to like that they're at least making some moves. 3D printed
Right.
candies, Nutella combat spread. I like that they're just not sitting on their laurels and just saying, we're Hershey, come and invest in us.
Having a little fun, yeah.
Exactly. Why not? All right, before we go, we've got a game to play. Buy, sell, or hold. The rules of the game are simple. These guys have to decide whether they would buy, sell, or hold a company based on the information I give them. And today's company is Best Buy. Shares of the big box retailer plummeted today on the news that holiday sales came in lower than expected. Now, before we get to your calls on Best Buy, what happened to Best Buy? What's going on? They're down 27% today.
A little extreme.
God, a little extreme.
No, they came out and said that their holiday sales were because of massive promotions, which we've heard from every retailer. Year-over-year sales were down 0.9% or something. Correct me if I'm wrong. Something like let's call it 1%.
Yeah, those were the domestic counts.
Yeah. So and stocks down 25%. So the trick is, and what I think happened, the real cause for the sell-off is that was all they said. They said year-over-year sales were down 1%. Comps were not that great, but it was because of promotions. But I think the stock sold off because they didn't say anything about profitability. And everybody knows if you're giving away promotions,
profitability is.
Well, I think they actually did have a call. They did give a little bit of color on that, and they did because due to the highly promotional environment, I mean, it was a ridiculously promotional environment this past holiday season. Every retailer was discounting their wazoo off. They do expect fourth quarter operating income to dip from the year ago levels. So it's going to be down like some. Exactly, surprise. No surprises there.
And this is the quarter they make most of their money. They make like 75% of their profits in those 3 months.
Absolutely.
So I don't know.
So all that being said, buy, sell, or hold.
Given the fact that I sold in the high 30s, I'll keep that call and stick with sell.
All right, fair enough. Fair enough.
Good move. I also agree with sell, in my opinion. I don't necessarily see the promotional environment escaping anytime soon.
Right.
And you figure that your Best Buy, specialty retailer, you're competing against the likes of Amazon. One of the things, of course, with the Renew Blue transformational kind of program that they're undergoing, there's a reason why their top 3 points are they've got to lower their cost structure, grow their online channel, and innovate for the multi-channel customer. All 3 of these are designed. They've got to try to compete against Amazon.
How are they supposed to lower their cost structure?
Exactly. Well, they've removed a lot of stores. They sold off a lot of stores to their credit, and there's a lot of efficiencies I'm sure they can make. But in order to kind of compete against Amazon's scale and compete toe-to-toe price-wise, I don't see it happening.
Absolutely. All right. That's going to do it for today, folks. For Michael Finarelli, for Sean O'Reilly, I'm Mark Reith. Thanks for watching. We'll see you next week.